Hello Dairy Today viewers. On behalf of the Market 360 advisory team here at Stewart Peterson, I'm Tom Mongovin, and this is your week in review for the week of August 24th, 2012. Let's take a look at our CME dairy components. These are changes on the week after the close on Friday afternoon. First, let's take a look at cheese. Blocks finishing at 185 and a quarter, down just about 2 cents this week. Barrels at 180 and a quarter, down just over 3 cents. Butter traded higher this week, up to 180. Whey was also higher this week, while non-fat dry milk settled slightly lower. Taking a look at the weekly changes based on Friday afternoon's close, September dropped 52 cents on Monday and then pretty much remained lower on the week, gaining back only 5 cents between Tuesday and Friday's trade. The sharp decline on Monday could have been due to traders reacting to the milk production report that was released last Friday that showed milk production was actually higher year over year for July of 2012. Many were expecting that number to be lower year over year due to the record heats we were dealing with in the month of July. Other changes include August, which is front month, so it's rather insignificant, but that was up 6 cents. September, as we mentioned, down 47, and fourth quarter milk prices down anywhere from 12 to 24 cents on the week. As we just mentioned, the block barrel average was down 2.5 cents this week. It was a fairly quiet trade this week, except for Thursday, which saw 13 blocks and 3 barrels trade when we saw the cheese trade last the full allotted time. That does not happen very often. Today, on Friday, it was a little quieter, with some sellers entering the market to drag prices slightly lower. The block barrel average is still in an uptrend, even though it was down this week to settle at 182 3/4. Here is the September milk on a chart, and as you can see, milk did drop off with this red line here on Monday, down 52 cents, and then Tuesday through Friday pretty much hung out right in that region again to settle 47 cents lower on the week. We are still watching the double bottom for support at 1807. Here you see one of those bottoms, and then there's another bottom right at 1807, so that should be key support for the time being. As far as resistance on the upside, watching that 1974 levels, you could see a high reaching here, and then another high reaching here, so kind of in between that range for the time being. For the latest 2-week period ended August 17th, the average Oceania cheddar price held steady at $1.61 per pound. With the CME price hovering right around $1.83, this has us as a 22-cent premium to Oceania. You can see from the chart that this has happened before, but it doesn't last too long, and when it corrects sharply. So let's take a look at the last 2 times this happened. Here you can see the blue line being CME, so we were above for 4 reporting periods and then a sharp decline lower. It happened a little bit later. Here you can see us up sharply here for 1 reporting period, sharply lower. And here you can see the most recent coming out to current prices. You can see we've been up higher than Oceania for 4 consecutive reporting periods. Who's to say what's going to happen next, but history shows us that we will correct, and it should be a sharp correction. On Wednesday, we had the cold storage report come out for the month of July, and total cheese in cold storage was down 4% from July of 2011. As I bring in the year-over-year changes, you can see that this is the largest year-over-year decline in cheese stocks since February 2012, right here where we saw a 5% decline. We will see in more detail on the next slide. I'll present these changes on its own individual chart. The last time cheese stocks fell year over year in the month of July was 2007, and before that was 2005. Here you can see the year over year changes plotted out on a graph. We started out this year in January down 7% year over year, which you can see from right here. That's January 2012, down 7% year over year. And that is bullish because it says we have less supply available than the previous year. We had been trending higher in recent months until June, where we had basically no change in inventory levels year over year. But as we just mentioned, in the latest report, we saw a decline of inventories again, which could be supportive to prices in the short term. So January 7, 7% below year over year. Again, that is bullish. We started getting positive and more closer to parity with last year. In June, we were basically at the same level, and then the most recent data down. So lower inventory levels means lower supply available, which is bullish for prices. Looking ahead, not much in the way of fresh new news coming out until September 12th, where we see the USDA report come out. That'll give us an update on where the USDA is thinking that corn and soybean yields will come into play. And also September 11th will be our dairy export report. That will be interesting to see because that will reflect CME prices at a premium, so we'll see if we are pricing ourselves out of the export markets and do see lower exports. That will do it for us. On behalf of the Market 360 advisory team here at Stewart Peterson, thank you for watching and have a great weekend.